Welcome to another episode of Rich Dad StockCast, where we help you navigate the world of investing and financial education. I'm your host, Denney, and today we have an urgent and timely topic to discuss. The storm is almost here, preparing your investments for economic turbulence. Now, before we get started, remember to like, subscribe, and leave your comments below. Your feedback helps us bring you more of the content that you want to hear. Don't forget to visit StockCastBonus.com for free access to valuable educational resources to boost your financial education. Now, joining us today is Rich Dad expert Andy Tanner. Andy, welcome back to the show.
I can't wait for this topic, Del. Thanks so much. This is of all the episodes that we've ever done, I can't think of one that could be more beneficial and has more benefit to someone to spend some time and evaluate. We're talking a lot about vigilance here. We'll talk a little bit about Chicken Little and the sky is falling and crying wolf, as opposed to Paul Revere. When it's really coming and it's time to get ready.
Now, I think we've all kind of seen some of the writing on the wall with the storm that's coming. But for yourself, what indicators suggest that an economic storm is approaching?
Yeah. So we could spend 1,000 hours on this. There's so much data on this right now. But I think I'd begin that answer with, and it's a long answer, but I think I'd talk a little bit about Warren Buffett. One day, one of the best quotes he's ever had, and it's so true. It is so true. He said, quote, "I will tell you how to become rich. Close the doors. Be greedy when people are fearful." And this is a big one. Be fearful when people are greedy. And that's absolutely what if you watch how he has invested, that is exactly what he has done. When people are at their highest level of confidence and they're greedy and they're investing heavily, that's when you have to start to be afraid. And so there's a literal gauge in the markets that gauges fear and vigilance. And you can absolutely tell when people are investing with, what we might call irrational exuberance or high confidence, and when they're investing with tremendous fear. And so I'm going to frame this around insurance and the cost of insurance. Ironically, if you look at Warren Buffett's quote and pull it apart, people, when they're fearful, will pay the most for insurance, and people, when they're confident, will pay very little for insurance. And so if I don't think my house is going to burn down, I might go with cheap insurance. But if I'm afraid my house might burn down, I might go with more expensive insurance. It's all about belief. So we get a gauge on how people are afraid, their confidence level or their fear level, based on the premium they'll pay for insurance. And in the stock market, these are called put options on the S&P 500. That's a great measure of just overall concern and fear. And we call this index the VIX. It's called the Volatility Index, VIX. And this volatility index is so low that it denotes a lack of fear, a lack of concern. And I will just tell you, if you know anything about history, Buffett's right. When people start to invest this aggressively at these rates, with this Fed policy, and they feel everything is fine and the market's at all-time highs, be freaking vigilant. So the first indicator I'm looking at is I'm looking at the fear gauge. And then you want to talk about some others? We have, this could be a 5-hour answer. We have an inverted yield curve. And I interviewed the guy who wrote the thesis on this the first time. He's still at Duke University. He's the dean of their business school, and he was on on my other podcast, on the Cashflow Academy podcast, a couple of years ago, and he wrote a paper about the inverted yield curve and what that spells for how investors think. So if we're paying huge amounts of money now for short-term loans, and we're paying less for long-term loans, that's backwards. I mean, that's jacked. You would think that a long-term loan would cost far more because there's so much time risk in that, right? So many bad things can happen. What that means is when you're paying a lot now for short-term money and you're paying less for long-term money, that means that investors have a belief that things are going to be rough in the future and that rates are probably going to have to be dropped by the Fed. We have a debt. And the amount of debt, there's 1.6 trillion in student loan debt. There's $1 trillion in credit card debt. There's 17 trillion in mortgage debt. There's a huge amount of aggressive debt, and people are still trying to go into debt a little bit less aggressively with these high rates, but it's still growing. That's a huge problem. That can create dominoes where people they get in a squeeze. When you have a pullback in the market, this is really important. This might be jargon and it might be above some people's pay grade. It shouldn't be, because it's not a complex thing. It shouldn't be. But when you have a pullback, people are forced to liquidate because they get in a cash flow crunch. For example, let's just do a real basic real estate deal. Let's say you have a real estate deal and it's running too hot and you have way too much debt and very little equity in there. And all of a sudden you have a cash flow problem where, let's say that, rents drop, that the amount of, that we start to have a depression, we fight this inflation huge, and rents deflate. Well, your payment doesn't deflate with it. You have a fixed rate. And so that instrument of debt, if you're running too hot and the rents go down and you get underwater in that thing, you're forced to liquidate. Does that make sense? You're forced. If you can't pay your payment, then your house goes into foreclosure. You're forced to sell that house in an auction and bankruptcy and everything. I mean, it's just that quick. If the cash crunch happens, if the cash flow constricts and it constricts below the level of debt that you have to cover, now that's what's called being caught with your pants down, or caught, what Warren Buffett says, you were swimming naked when the tide was in. When the tide went out, when the cash flow left, you're now exposed. Well, the same thing happens in stock markets, and our leverage, the amount of leverage that's being used in stocks right now, marginal debt is what we call it. It's huge right now. It's at a really high level, which again speaks to the confidence. People borrow when they think things are going to go well. Well, when they don't go well, it just, you have to liquidate, and that's when the real savvy investors that have been wise and have their cash on the sideline, they have their dry powder, they pounce and they just get deals. That's, I think, one of Robert and Kim's biggest accelerations in wealth was in the crash of 7 and 8. When those things all went on sale, they were able to buy like crazy with Kenny, and they were very, very aggressive. So a guy like Kenny right now is pulling back in what he's buying. He's got his investors ready. He says, guys, we're going to stay ready for a while. Just be at the ready. And it sounds like Paul Revere, doesn't it? Be at the ready. Grab your freaking gun and defend your family. The redcoats are coming. Be ready. So, we could go on and on and on. You've asked one question, and I can go for hours on this. When you look at the amount of public debt and the rising healthcare costs, the fiscal path of the United States of America, my home country, it's not that I'm not patriotic. I'm just looking at the numbers. They have one of the most difficult balance sheets. Even though we're a huge economy and lots of money and great, there is an unsustainable, that is the word. It is not going to be able to continue. And as that gets bigger and bigger, that's a huge problem. Bond liquidity is a problem. And I shouldn't move off that fiscal problem. So we have 30 plus 32, 33 trillion we've already borrowed. That money's been borrowed and spent. That's called debt. That's debt we've taken on. We've borrowed that money. We've issued the bonds. The money's come in and we've spent it. So now the taxpayers have to pay these investors back. They have to pay these loan, they're borrowers. They have to pay the people loan the money back. But the bigger number is not what we've borrowed, it's what we're going to have to borrow. It's the commitment level, what we call off balance sheet or unfunded liabilities, promises that have not been funded yet, money that has not been borrowed yet, money has not been received yet. So that is a real key part of financial education at every level of personal, corporate, and I write about it in my, we've got the new version of Foreign Chaos coming out this fall, and I write extensively about this. It's the promised money that a person needs to understand as much as what's been borrowed. We have a generation of people that we've promised healthcare to, and as they age, those promises increase. As inflation hits, the amount we owe increases. If you promise healthcare, you didn't borrow that money yet. And so that's north of 200 trillion, Dell. And I got to tell you, when you and I were first, getting going and stuff, we had like $1 trillion deficit, $1 trillion debt. Now we have a multi-trillion dollar deficit. When you and I, first met 20 years ago, our unfunded liabilities weren't even 100 trillion. Now they're 200 trillion. It's grown in the last 2 decades. It's unsustainable. It's going to get to a point where we can't pay it. The interest on this new debt that we're having to issue now, because the Fed, this is what they're not thinking about, because the Fed has had to raise rates to curb inflation. What does that do to the financial stability of the United States, where now the interest that we're paying now on this new round of debt, these are 30-year loans with huge amounts of debt on them. They can be moved, they can be liquidated, they're marketable securities, but whoever's holding the bag at the end still has to pay that money, which is the taxpayer. So that's unsustainable. I could go forever, Del. The stuff that is out there that looms, when we have a pullback, it could be pretty big. It could be a big one. We go on and on and on. What I think is important is that people learn how to defend themselves on this, and be vigilant. So long answer, but you asked.
No, you're right. No, I absolutely.
You asked.
You're right. I asked, and it's good to get into the data. That's good to make decisions through data, right?
Be data driven.
We have to be data driven. In just a moment, I want to take a quick break, but when we come back from the break, I want to talk about how we can prepare for the pullback, right?
Yeah.
So let's go to break, and we'll be right back, and we'll talk about how to prepare for.
It's going to be awesome. It's going to be awesome.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning, as well as it's really solidifying in my mind. And they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to this episode of Rich Dad StockCast. Again, our topic is the storm is almost here, preparing your investments for economic turbulence. Now, before we get back to Andy, remember to like, subscribe, and leave your comments below. Your feedback helps us to bring more of the content that you want to hear. And don't forget to visit StockCastBonus.com for free access to valuable educational resources to boost your financial knowledge. All right, so let's get back to our topic, Andy. And we've talked about the data. We've talked about, the storm that's brewing. Now the question is, before this big pullback comes, how can we start preparing our portfolios for this economic turbulence?
Well, you use a great word with turbulence, and I would look back at history repeats itself. AI, we could really go further with the other discussion. We only have so much time. There's other data we could go through and other circumstances we could talk about. It's only a half-hour show. But when you look at the disruption of AI, the internet was a disruptor. And what that created was greed, opportunity, high-risk stuff, volatility. And you had, companies like Alta Vista and the web crawler and Ask Jeeves and Yahoo and Google came out as the winner. And so people were placing bets on all those things, and Google was the one that worked out. AI is going to be the same. To think that there'll be no disruption and no tumultuous periods, that we're just going to have this smooth sailing upward all the time, that's just ludicrous. That's just not how markets work historically, And it's not like the Fed has just solved it now, right? There's going to be tumultuous times. Well, the smart person looks at this in two ways, I think. The first one is and I loved your word you used before the break, is you didn't say predict, you said prepare. I do not know what day this is going to happen, but it's vigilance. So let me use some analogies that are outside of the stock market to maybe help newer folks that are new investing or don't understand all those numbers I just rattled off, or those circumstances, which that's the easy numbers. The hard ones we don't even bring up because it's just over everyone's head. But here's the thing I would say. Let's say that you are watching the news and you live within a 5-mile radius of a state prison, and they announced that there were 10 guys that put together a scheme. They escaped from prison. They're armed and dangerous, and they've decided not to stick together. They've decided to separate to make it harder for everyone to find them. And they've been breaking into people's houses. They're armed and dangerous. Okay, what does that do to your vigilance? Are you going to lock your door that night? You probably just have a greater amount of vigilance. Now, it doesn't mean they're going to get you, but you're going to have better, vigilance. If the meteorologist predicts rain and you were supposed to go to the beach that day, you're going to take an umbrella. If you live in a flood zone, you're going to want flood insurance, right? And it's going to cost you some. So the idea of buying fire insurance does not necessarily mean you're predicting a fire. You just know that the risk of fire is present and that could happen. And so you're vigilant. You're prepared for those things you can't see coming. But when you can see it coming, if all of a sudden you find out that your neighbor kid is a pubescent arsonist who is starting fires all over the place, you better have your fire insurance because your risk just went up, right? This kid's playing with freaking matches all the time, lighting all your neighbor's houses on fire, right? I mean, it's just vigilant. When you can see it coming, be vigilant. It doesn't really matter when it happens, whether it's let's just use Warren Buffett, whether it could be today, tomorrow, 1 year, 5 years, or it could be 5 years, 1 year, tomorrow, or today, right? It could be any of those things. So we want to treat today, tomorrow, and a year from now with absolute vigilance and being prepared. So what can a person do to be prepared? Number one is you want to have your knowledge before. That's a real key. You want to have your knowledge set and in your skill set before. One of the things that is tough about this in terms of preparation is to drill it. Now, what do I mean by that? This is so important to know how to drill. When I was a kid and I used to work construction, we'd have a sign. I worked heavy industrial construction. I worked heavy construction, huge equipment, just massive equipment. And, I saw 2 people pass away in one summer, right? And I've seen 3 pass away on the job site when I've been there. There was heavy accident. We used to have a sign that said, okay, we've had, 21 days without a lost time accident. Oh, we've got 32 days without a lost time accident. And every Monday on these job sites, you'd have a safety meeting. And there was one particular job I had that was really dangerous. It was out at the Tooele Army Depot where they had all this mustard gas and nerve gas from all these chemical weapons stored from World War II. And they were starting to decay. So they're building a demolition furnace to get rid of all these nasty weapons. Well, you've ever seen The Rock with Nicolas Cage where he has that pen, he stabs himself in the heart? It actually goes in the leg, not the heart. But we would drill that. Because a nerve gas leak only happens once a century, but you have to drill it every week. Well, if in my investing tenure, the .com, I missed the one in 87 because I was just a year out of high school, wasn't investing. So I missed that one. But I participated in the .com. I participated in the subprime meltdown. I participated in COVID. So in a 30-year career, that's only 3 of them. It's only 3 times I've had to deal with that. Now, the last one was the best one because it was my 3rd time around, and it was just I'd been there twice before. So the last one, I handled each one better than the one before. And the last one was the best one I've ever had. So the problem people have is in a major crash that can be coming, these people, COVID was the tryout, because COVID was caused by a pandemic, and they just they kicked the can down the road, rode the snowball up the hill with just fake money, right? They just printed money. So all those problems that were starting to get revealed with COVID when we had a problem are still there. It's just the Fed was able to get it with one more round of money printing. I don't think that's the case this next time. I don't think they can handle it the next time. So to prepare, you got to drill. You've got to have a drill. I had a friend of mine, he's got we'll just say it's north of $1 million. Okay. Well, north of $1 million. He says, Andy, I don't know how to protect this money. Well, you have to have the plan in beforehand. You have to have drilled it and beforehand. I've even thought about doing a class just on this, is how do you prepare for the once in a 10-year, 6-month period, right? How do you do that? You do it with delta hedging. You do it with beta weighting. And the beautiful thing about, what I will do, what my plan will be, is we'll be very vigilant, very reactive. When it happens, we'll load up on hedges. In other words, we'll get in bearish investments to neutralize the portfolio. In other words, I won't make money and I won't lose money net. But as what happens is, as the assets begin to drop, the benefits to the insurance I bought begin to rise. So, here, let's just say this was $1 million. Well, as this goes down, 500,000, this goes to 1.5 million, right? Or something like that. So you have this effect of, well, this is what's beautiful. So now all the assets are low. You can now cash in this insurance, and you can now buy back down at the new level and rise together. And you do that over and over with every crash. And so your insurance fills you with money, because where the analogy ends, Del, is if I wreck my car, State Farm or Geico or Allstate, they don't buy the car, they fix it. It's an expense to them. Me, it's different. In stocks, you don't have to sell your stocks. You keep all that stocks damaged, and they heal on their own. They heal on their own in the upswing. You cash in your insurance. So now you have a whole bunch of money to reinvest. A good example of this was ExxonMobil. I was buying Exxon at 55 before COVID hit, and I saw COVID hit. I bought some put options where it went down. Well, I kept the ExxonMobil. I didn't sell it when it went down, but I sold the put options for profit. Now my new cost basis for the new Exxon is $33, right? It's incredible. So you want to learn to delta hedge, beta weight, use options, use futures in some cases, and have a plan ready to know where your delta neutral is so you can calm the storm. And with a couple investments, you can go delta neutral where you're just protected. You start. Now, there'll be some whipsaw through these times. You'll have investors that you'll have a 600-point drop in the Dow, and the next day it'll be up 4. You'll have some tumultuous times when this happens. So going through those drills, for the once in a 10-year scenario, it's worth millions and millions of dollars to people. So that's how you prepare. You learn what these instruments are. You practice with them in your paper account. You run scenarios beforehand. One of the things we have an advantage is we have a Series 4 option principal, on our team, who manage hundreds of traders on the trading floor at a time in the aggregate risk management. So we have resources of education that are really is high. They're world class. And so I'll give it a plug. StockCastBonus.com. Go. So I know these are long answers, Del. I know they are, but these are big questions.
That they are, and I love these answers, because I'm learning so much here. And you also mentioned that the ups and downs. How can investors take advantage of market volatility?
It's called a transfer of wealth. So it's just what side you're on. We don't look at, excuse me. I don't look at things, Robert Kiyosaki has been such a great teacher to me. And I remember the first time he said this, I thought that is so simple, but it hit me right in the middle of my chest. He said, Andy, I don't have a right hand and a wrong hand. I have a right hand and a left. He says, Andy, I don't have a right foot and a right foot and a wrong foot. I have a right foot and a left. And he really taught me that not everything is good as bad. For example, is the liability column bad and the asset column good? Not at all. They just are what they are. They're just assets and liabilities. If I buy something, think about this. If I buy something and I put it in the asset column, is that good or bad? It's bad if the asset loses value. If I borrow something and the value of that goes down in the liability column, that's good. So it's really about the direction things go that make them good or bad, not what column they're in. Borrowing things that go down in value, like a dollar, makes you rich in an inflationary environment. Buying things like an asset that go down in a deflationary investment is a bad move. So, good and bad isn't assigned to asset and liability. It's the direction things are going. So once you understand the direction, you can position that financial statement to benefit, and actually it can be the best of times. That's a often spoke line, but the best of times for some and the worst of times for others. One man's paradise is another man's prison. One man's burden is another's opportunity. There's no good and bad. So when you have this transfer of wealth that is so massive, people can look at it opportunistically to the degree they want to. I will be a little bit in the middle of the road. There'll be a lot of defense, less opportunistic thinking. There'll be some, but others, if you don't have anything to lose anyway, it actually, for some, they'll bet big, like Michael Burry, like the Big Short guy. He bet big, and he's made big bets since then. So there is opportunity both in protection with options, but also to look at them opportunistically. And the leverage is huge in these markets that you can have. So, but leverage requires education to use wisely.
100%. And I want to ask one more question, just because I know we're getting towards the end of our time here. And it's a really important question. What role does cash play in preparing for economic turbulence?
Cash is critical because cash becomes king in tough times. And it's not how much cash you have, it's what I call buying power. That's a real big difference. Warren Buffett does not like storing cash. He doesn't like it. He prefer to invest it. But if there's nothing great to invest in, he'll keep some cash. A guy like, Kenny McElroy and, my friend Van Merrill, what they have is access to cash through lists of accredited investors, where they really don't have as much as their own cash, but they maybe have a list of 100 or 1,000 or 2,000, however many, accredited investors say, look, our cash, we don't know what to invest in. Our cash is on the sidelines. So their message to them would be, hey, the British are coming. They're coming. It's Paul Revere. Have your powder ready. Get your gun, because when I call, you're going to want to be able to pounce. And that's where Buffett is. That's where those guys are. So it's not so much the cash you have in your hand. It's access to cash. And it's really access to debt when everything's at the bottom. Going into debt at the bottom is beautiful because you're borrowing money to buy things on the cheap instead of borrowing money to buy things on the expensive. You're going into debt when the tide's out and you're fully dressed, right? You got your bathing suit on. Then when the tide comes back in, you still got your bathing suit on. So when the tide goes out, that's a great time to get your bathing suit on and get in the water, because when it comes in, you're swimming with your bathing suit. So it's good stuff. Cash is important. It's important to understand deflation, inflation, monetary policy, to know when you want to have cash, access to cash, buying power, or when you want your money in a specific asset. So it's a great question to end with. Biggest thing I'll do is I'll plug that thing. Every once in a while, I'll stream right here in our classroom. We back out, we rearrange the set so we have the TV and the ability to teach. And, people can spend a day. In one day, I can take people from zero to a really nice understanding if they invest the time. Can't do it in a 30-minute podcast, but you can do it in a full day. So go to StockCast bonus and get ready. I would feel sick there's 3 million people, 3 million subscribers on the Rich Dad channel, give or take. I would feel sick if I did not adequately warn and provide education before this happens. And besides, you can learn to cash flow in the interim, right? You can learn to increase cash flow while you're waiting for this thing for the shoe to drop. So I would be sick if I did my part. Now, if I've done my part, and those guys going to want to go watch Netflix or something next, or spend a day, doing whatever people do, barbecuing or whatever, well, then I've done my job and nothing I could do. You can't force the horse to drink, but I can bring it to the water. So that, as long as I've done my job, I'm okay with it.
Absolutely. Well, Andy, that's a wrap for today's episode of Rich Dad StockCast. Now, everyone else, I hope you found this discussion on the storm almost here, preparing your investments for this economic turbulence, insightful and valuable. And a big thank you to Andy Tanner for sharing his expertise with us. Andy, that was amazing, man. I love that. I wish we had more time. There's so much more. So remember, whether you're a seasoned investor or you're just starting out, the key is to stay informed and prepared. And speaking of preparation, just like Andy said, don't forget to visit stockcastbonus.com for free resources that can help you navigate these challenging times. And so if you enjoyed today's episode, please make sure that you like, subscribe, and leave us a comment. Your feedback helps us to improve and bring you more of what you want to hear. Share this podcast with your friends and family to help them make better financial decisions too, as we're preparing for the storm. Thanks again for tuning into Rich Dad StockCast. Until next time, stay smart, stay invested, and take control of your financial future. I'm Del Denney, and we'll see you on the next episode.
Thanks, Del. We'll see you next time, folks.
This podcast is a presentation of Rich Dad Media Network.